The Federal Reserve just cut interest rates again and confirmed what we've been warning about for months. Quantitative tightening will officially end on December 1st. This isn't a small policy tweak, it's a clear pivot. The moment the world's most powerful central bank shifts from tightening to easing. Most investors won't realize what just happened until the liquidity has already hit markets. But make no mistake, the tide has turned. Ending QT removes one of the biggest drains on reserves, and balance sheet growth is likely to resume gradually over time. Liquidity is back on the move. Today, we'll break down why this pivot was inevitable, walking through the mechanics, the politics, and the playbook. And with help from Alden, we'll connect the dots to what this means for risk assets, the broader economy, and Bitcoin. If you've seen our recent videos, you already know the pattern. Markets don't move on dates, they move on liquidity. When liquidity tightens, everything struggles. When it eases, everything breathes. The Fed just started easing, not because it wants to, because it has to. Monetary policy was built for a different era, when bank lending drove money creation, demographics were tailwinds, and deficits were manageable. That's not the world we live in anymore. Today, the big lever is fiscal, structural deficits, aging demographics, interest expenses feeding back into even larger deficits, Treasury issuance skewed towards short-term bills. These are the engines now. The Fed isn't driving the car, it's the handbrake trying to slow it down. That's why the last 2 years have felt so strange. Rates soared, bank lending slowed, housing cooled, but inflation refused to follow the textbook because the real driver wasn't credit, it was government spending. If you still think the Fed funds rate is the master dial, you'll miss the real story. If you think the end of QT is just technical, you'll miss the flood. Alden explains it best.
Pointing out that the key driver of this inflationary spike we've seen has been fiscal. That's been the biggest source of it. Of course, the Fed partially enabled fiscal by monetizing a lot of those bonds, but the main driver was that fiscal decision. You of course had temporary supply bottlenecks, but they largely resolved themselves, and so the permanent price increases we see are largely due to monetized fiscal deficits. A lot of people, when they have this inflation fighting framework, they think of the 70s. They think of Paul Volcker. And the issue there is that the majority of money supply growth back then was not from fiscal, even though there was a fiscal component. It was from bank lending. And that's because demographics were very different then. Baby boomers were entering their home buying years. So you had kind of peak rates of bank lending, credit formation in that period, combined, of course, with oil shortages, all the geopolitical issues that led to that. So you had that supply side constraint, and then you had above average bank lending activity. So by drastically raising rates, Volcker did a couple things. One is he slowed down that bank lending, and two, he strengthened the dollar, which then it crushed dollar indebted emerging markets around the world. So it reduced their commodity and oil consumption. Brutal. So it relieved that supply side while also slowing down to some extent the demand side in the U.S. And that fought inflation. The problem is when you have fiscal driven inflation, if you raise rates, you're slowing down the private sector borrowing. But that's just offsetting the fiscal side. You're not slowing down the fiscal side. If anything, you're mildly accelerating the fiscal side due to the interest expense component we talked about. And so if you look at the data, bank lending has been pretty weak for a while now. It's starting to wake up a little bit, but especially throughout 2022, 2023, bank lending was very weak. That was never the source of inflation this entire cycle. So they're kind of targeting the thing they can. Their tools are mostly based around that bank lending channel, and it's just they're doing this almost because they have to. And so as they ease, you'll probably see a slight uptick in bank lending activity, which can contribute to economic growth and price inflation, money supply growth.
The inflation shock came from fiscal policy. Rate hikes slowed the wrong thing, and ironically made deficits worse by increasing interest payments. When fiscal dominates, the Fed's tools are blunt. And that's why the next part of this story, the end of QT, was inevitable. Quantitative tightening slowly squeezes the oxygen out of the banking system. With the reverse repo facility now near zero, and bank reserves slipping below $3 trillion, further QT would start cutting into the core of financial plumbing. Everything works fine, until it doesn't. And the Fed knows exactly how much air is left. There are three pools that matter most: the Treasury General Account, the government's cash balance, the Reverse Repo Facility, RRP, parked liquidity that can drain or refill the system, and bank reserves, the real oxygen level for the financial system. Those buffers have been shrinking, The easy offsets are gone, and now the strain is showing, not in crisis form, but in subtle funding stress that's appearing mid-quarter instead of just at quarter end. Sound familiar? It should. We've seen this movie before, in 2019. Only this time, the Fed has a standing repo facility ready to contain the symptoms. But even that's a bandage, not a cure. You can't run a global financial system on emergency patches forever. Here's how Lynn connects today's moment to the 2019 liquidity crunch, and why QT is ending out of necessity, not choice.
For context, back in 2019, it was Twitter at the time, we had it was the September 2019 repo spike. That was one of those like little economic crises that most people didn't have to worry about. But of course, anyone in macro trading on FinTwit at the time was freaking out about. And you had kind of competing narratives at the time. The reason that's relevant is because this is somewhat similar to that, just less compressed. So back then you had some people, you had kind of the bears saying, oh, something broke in the banking system. Banks don't trust each other. This is going to portend something large. Now, ironically, months later, we did get COVID, but this was all before then. So it was like some major bank might have failed or this, and then the other side was kind of saying, this is just a technical issue. It's not a big deal. It's no, it's not too much debt. It's not any of that. And there was a camp that was like Luke Gromen, myself, and some others saying it's not really either of those two things. It's basically there's a liquidity shortage, but it's not ultimately a repo problem. It's basically a T-bill oversupply problem relative to other types of liquidity that were available. And so although the Fed was putting out the fire by doing repo activities, that they were very likely going to go to start permanently buying treasuries. A couple weeks later, in like mid-October, they did exactly that. So this was all pre-COVID, before all that hyper stimulus. They ended their quantitative tightening. They went back to kind of persistent balance sheet increases. Now, they didn't want to call it QE because one, it was not for the purpose of economic stimulation, and two, they were not buying longer end of the curve. They were buying T-bills, and it was basically to just keep banks liquid so that they could meet all of their liquidity, kind of requirements while continuing to lend.
The pressure isn't catastrophic; it's structural. QT is ending not out of choice, but because reserves are approaching their lower bound. The balance sheet will flatten, then likely resume slow growth in line with nominal GDP. It's not panic, it's policy by design, and it sets up the next phase, the quiet return of liquidity. When people hear balance sheet expansion, they picture 2020 style QE, massive bond buying, money printers, chaos, but this time is different. The next phase will likely rely on reinvestments and bill-heavy treasury purchases that rebuild reserves without pulling long-duration risk out of the market. Here's how it works. The Fed creates new reserves, absorbs T-bills, and keeps banks from breaching liquidity thresholds. That frees balance sheets, stabilizes funding, and restores oxygen to the system. No headlines, no fireworks, just a slow tide of liquidity, and that tide still lifts boats. Here's Lynn explaining why even this subtle shift is still profoundly pro-risk.
How do you unpack the contrast between those two?
Right. So it's not a direct impact on duration. It is a direct impact on quantity, which is to say that if the Fed is not reducing their balance sheet, or if they're outright decreasing it, and a lot of T-bills are coming to market participants have to absorb those somewhere, which means they have to not own another asset. Now, if the commercial banking system is absorbing them, that's fine because they're doing it on fractional reserve. But if they start to run into those pretty low cash levels, then even they have trouble just keep gobbling up T-bills. And so then you have kind of non-levered or less levered entities having to absorb these T-bills, which basically is almost a one-for-one not owning something else. And so when they swap reserves for T-bills, before the swap, of course, they create the reserve out of nothing. So for the bank itself, it's a neutral trade. But for the market as a whole, it is net liquidity entering the market at the base level, and it allows basically the continuation of banks buying treasuries. It allows the continuation of banks making loans without going below their either preferred or required liquidity thresholds that they have in various ways. It's adding more kind of that base layer to the system. So of course we have two main layers of money. There's base money, and then there's broad money, and the third layer on top of that is all securities built on top of that whole apparatus. This basically gets rid of that base layer constraint. So we kind of squeeze everything until the broad money was still growing, the overall amount of securitization was still growing, but the leverage on that base was getting pretty significant and tight. And so once that base starts to go up again, it frees up those higher layers to some degree. So it is, I would argue pretty firmly, it's net liquidity boosting.
Direction matters most. Flat balance sheet to gentle expansion, plus rate cuts, marks a full liquidity regime change. And since the Treasury has favored short-term issuance, a Fed that's no longer shrinking reserves reduces the pressure to extend duration anytime soon. Which leads us to the next chapter, the unspoken partnership between the Federal Reserve and Treasury. Call it financial repression, call it soft yield curve control. Whatever the name, the goal is simple. Keep the government funded, keep the banking system liquid, let the rest absorb the pain. If mortgage-backed securities roll off while treasuries are supported, you know where the thumb is pressing. It's politically convenient, it avoids another bond tantrum, and it lets the Fed say policy is still tight, while quietly refilling the liquidity pool behind the scenes. Different stories for Main Street and Wall Street. Same outcome, more reserves, more oxygen, and rising risk appetite. Here's Lynn breaking down how this financial repression quietly works.
That is a potentially stimulatory thing. Now, he would be going against kind of prior statements, which is that he wanted to kind of normalize their ratio of T-bills. So that would be kind of somewhat of a field day on Twitter and X. He previously used the debt ceiling as one of his constraints, saying we're not going to rush to that approach. And generally speaking, when a government shifts toward more short duration, that is kind of like how fiscal dominance in a developed country gives you certain emerging market characteristics. This is like another kind of mildly emerging market characteristic. So in extreme sense, when an emerging market doesn't have any demand for its bonds, it often shortens its duration markedly. It can even turn over its whole government debt, like with overnight paper, if it has to. That's, of course, a very extreme scenario. So in this case, it's the developed market version of that. So you just kind of get a bigger than usual increase in T-bills, which it can be stimulatory, it can be inflationary, it can spook market confidence in kind of the soundness of this whole apparatus, because kind of Fed confidence and Treasury confidence are kind of a big component of all this. But I do think that those kind of things will happen. I think that we are in a regime of financial repression. It's not kind of like hard yield curve control, but it's kind of more softer tools. Even the fact that the Fed's going to be likely continue to reduce mortgage-backed securities, but then increase their Treasury holdings, that's kind of placing their thumb on the side of the sovereign government, while letting other rates potentially remain somewhat elevated or the spreads higher. And so I do think that that's going to be a meaningful component.
This is how fiscal dominance operates in a developed market without calling it that. Treasury shortens duration. The Fed stabilizes reserves. Together, they fund the sovereign, silently. It's not a bug in the system. It's the system itself. About those rate cuts. Are they warranted? On paper, yes. Labor cracks are appearing, wage pressures have cooled, and housing remains sluggish. But cuts won't fix the root problem. They're a patch for the private sector, not the public one. Fiscal spending keeps humming. Deficits keep expanding. And with cuts, inflation won't neatly fall to 2%. The Fed itself admitted inflation remains somewhat elevated, even as downside risks to employment grow. That combination, easing policy with persistent inflation, is catnip for markets. This is what Raoul Pal calls the liquidity phase shift. When monetary easing meets fiscal dominance, QT ends, reserves rise, the base layer of money expands again, and risk assets lead the charge. If liquidity is improving, why does everything still feel so bad for so many people? Because this recovery is split. Fiscal channels reward older and wealthier cohorts. AI-driven capital expenditure benefits a handful of tech giants. Meanwhile, the middle of the economy feels stuck. This K-shaped dynamic explains the disconnect between market performance and public sentiment. Low unemployment, but record low satisfaction. It's the new normal of a fiscally dominant world, where liquidity flows upward. But for investors, this split doesn't negate the macro signal. It reinforces it. When fiscal and monetary forces quietly merge, the path of least resistance for capital is still the same, out of currency into assets. And that's where the debasement trade comes back into focus. When liquidity returns, risk assets respond in sequence. First liquidity leaders, then duration plays, then higher beta risk. Crypto sits on the outer edge of that spectrum, which means it moves first and hardest when conditions ease. Gold has already run hot. maybe too hot. Bitcoin, on the other hand, has reset leverage, shaken out speculation, and now sits perfectly positioned for the next liquidity wave. As reserves rise and financial conditions loosen, Bitcoin historically thrives. Here's Lynn Alden tying the entire cycle together, from 2019's repo crisis to what she expects through 2026.
The repo spike in late 2019, that was kind of, I would say it was kind of the beginning of the debasement trade as far as I saw it. Then you had, of course, the whole COVID era hyperstimulus. Then 2022, you had a pretty big attempt to pull some of that back. So you got quantitative tightening, you got all the fiscal stuff, a lot of that evaporated. You got this kind of fiscal pullback. 2023 and thereafter, the rising interest expense started to impact the government, and the demographics continue to age. You started to get this kind of rising fiscal situation again. Ongoing debasement trade, even though the balance sheet was no longer a component of that. You had activist treasury issuance, so we're taking money out of reverse repos, we're putting that back into the system. And so you had this kind of interplay between the Fed and the Treasury for like 3 years, where the Fed was trying to gradually take liquidity out of the system. The Treasury was kind of trying to put it back in, mainly from the reverse repo facility. That was mostly just taking like unused liquidity and sticking it back in, just kind of distributing it back out gradually. And now we're going to be entering a period where we're back into net baseline liquidity happening. Now, even during those 3 years, you still had banks levering up on treasuries. So you had deficit spending fueled by fractional reserve, which means it wasn't like one for one. It wasn't like a private sector entity had to buy a treasury instead of buying a stock. As long as banks were a pretty meaningful buyer of treasuries and doing so on fractional reserve, it wasn't that one for one replacement. So it wasn't as tight as many people thought. So we've kind of been persistently in this debasement trade, other than maybe 2022. And I think that's going to continue. Now, I think that where that shows up best fluctuates. So I think that while I'm still long-term bullish on gold, I do think it's somewhat overdone in the near term. If you would have asked me, a couple of years ago, I would have said, yeah, I could see 3,000. I didn't necessarily have 4,000 on my radar, even as a bull. As someone who was long it this whole time, I would not have guessed we'd see, well over 4,000 at one point this quickly. I do think that Bitcoin, I think that cycle is not done. I do think we're going to see higher prices of Bitcoin in 2026. Could be wrong on that, but that's certainly my base case, because I think we'll see somewhat of a rotation there. Somewhat of an exhaustion in the gold market, somewhat of a bid up in the Bitcoin space, especially now that a lot of those treasury vehicle excessive valuations have been, deflated. So that's not really a headwind anymore. Then I think a lot, there still are pockets of equities that are interesting to benefit from the debasement trade.
The debasement trade never ended. It just changed shape. 2022 was the contraction. 2023 through 2025 was the tug of war between QT and Treasury issuance. Now we enter the next phase, net liquidity growth. That favors assets with monetary premium, and Bitcoin sits squarely in that window. The Fed's pivot isn't a press conference, it's a process. QT is hitting the wall, liquidity constraints are visible, and the system is preparing to quietly reflate. You can argue the politics, you can debate the fairness, but markets only care about one thing, liquidity. The 4-year cycle is gone. Liquidity is the new map, and liquidity is about to improve. If you want to stay ahead of these macro turns, subscribe to the Crypto Nutshell, our free 5-minute daily newsletter that breaks down liquidity, policy, and price into clear signals. No fluff, no noise, just what matters. First link in the description. See you all in the next one.